Warren Buffett once said, "The Intelligent Investor is by far the best book on investing ever written." That's coming from a man worth more than $100 billion. But here's the thing, most people who pick up this book never finish it. It's dense, filled with theory, and written in the 1940s. So in this video, I'm going to make it simple. We'll break down 5 timeless lessons from Benjamin Graham's masterpiece, lessons that can help you avoid big mistakes, build wealth over the long run, and most importantly, think like an investor instead of a gambler. Lesson 1, Investing versus Speculating. Let's start with the foundation. Graham said the biggest mistake beginners make is confusing investing with speculating. Investing means you buy something for less than it's worth, hold it, and let it grow steadily over time. Speculating is chasing quick wins, buying stocks because they're trending on Reddit, or because your friend said this one's going to the moon. Here's an analogy: imagine buying a rental property. If you carefully study the neighborhood, the rent prices, the costs, and you buy it knowing it will generate income for years, that's investing. But if you buy the house just because everyone else is buying in this area, and you're hoping to flip it in 6 months, that's speculating. Takeaway: always ask yourself, am I making this decision based on facts and value, or just based on hype and emotions? Lesson 2, Mr. Market. One of Graham's most powerful ideas is the character he called Mr. Market. Picture this: you own a business with a partner named Mr. Market. Every day, he knocks on your door and says, "Hey, I'll buy your share for $50. Or maybe I'll sell you mine for $150. The next day, he shows up again, but now he's depressed and says, "Actually, I'll sell you my share for $20. He's irrational, moody, and unpredictable. But here's the key: you don't have to listen to him. The stock market is Mr. Market. Prices swing wildly because of fear, greed, and headlines. But as an investor, your job is to ignore his mood swings and take advantage of them. Think back to March 2020. COVID hit, panic spread, and the stock market fell over 30% in a matter of weeks. That was Mr. Market having a breakdown. But for long-term investors who stayed calm, those prices looked like a clearance sale. Takeaway: the stock market exists to serve you, not to guide you. Be patient, and only act when the price makes sense. Lesson 3, Margin of Safety. Now, this is Graham's most important lesson: always demand a margin of safety. What does that mean? Imagine you're building a bridge that needs to handle 10 tons of weight. Would you design it for exactly 10 tons? Of course not. You'd build it for 20 or 30 tons, just in case. Investing is the same way. If you think a company is worth $100 a share, don't buy it at $100. Buy it at $70 or $60. That way, if your calculations are a little off, you're still protected. Warren Buffett used this principle in 1988 when he bought Coca-Cola shares. The stock had crashed after years of underperformance, but Buffett recognized its brand power and bought in at a discount. Today, that single investment has made Berkshire Hathaway over $20 billion. Takeaway: leave yourself room for error. A margin of safety turns uncertainty into opportunity. Lesson 4, Emotional Discipline. Even the best investment strategy will fail if you can't control your emotions. Think about the dot-com bubble in the late 1990s. Companies with no revenue were doubling in price overnight. Greed took over. People who had never read a financial statement were quitting their jobs to day trade. Then the bubble popped, the Nasdaq lost almost 80% of its value, and fortunes vanished. On the flip side, fear can be just as dangerous. In 2008, during the financial crisis, investors panicked and sold everything at rock-bottom prices. Those who stayed calm and held on, or even bought more, recovered and made incredible gains in the following decade. The point is simple: your biggest enemy in investing is not the market. It's you. Takeaway: develop the discipline to stick with your plan, even when fear and greed are screaming at you to do the opposite. Lesson 5: Defensive versus enterprising investor. Finally, Graham said there are two types of investors: defensive and enterprising. A defensive investor doesn't want to spend hours researching. They prefer simplicity and safety, think broad index funds, bonds, and diversification. An enterprising investor enjoys digging deep, analyzing businesses, and finding undervalued gems. This takes time, effort, and emotional resilience. Neither path is wrong. The key is to choose the one that matches your personality. If you don't like research, forcing yourself to pick stocks will only stress you out. But if you enjoy analyzing companies, being enterprising can pay off. Takeaway: be honest with yourself. The best investment strategy is the one you can stick with. Let's recap Graham's 5 timeless lessons. Know the difference between investing and speculating. Remember Mr. Market, his moods are your opportunity. Always demand a margin of safety. Control your emotions, they're your greatest enemy. Decide whether you're defensive or enterprising, and invest accordingly. These lessons might be 80 years old, but they're more relevant than ever. So let me leave you with this: successful investing isn't about being the smartest person in the room. It's about being the most disciplined. If you found this breakdown helpful, hit like, subscribe, and comment below with the lesson that stood out most to you. Because this is just the first of many videos where we'll simplify the greatest investing ideas of all time, so you can use them in your own journey to financial freedom.